It's time to wrap up investment year 23. The Sifter Fund rose by 31%, making it the third best year in our 20-year history. In this video, we'll go through which companies brought the highest returns and hear comments from our portfolio managers. Welcome aboard. The last 5 years have been challenging for equity investors, at least from a macro perspective. It has felt like there's never right time to invest. In 2019, the year ended with a strong rally and the market was relatively expensive. However, the rapid downturn during the COVID crisis wiped out the gains of the previous years, only to recover rapidly. Ultimately, during the pandemic year, the Sifter Fund rose by 10.5%. In 2021, stimulus money and low interest rates supported stocks, but the rise in inflation also started to create uncertainty. The value of the Sifter Fund increased by 34.4%. Once again, the market seemed expensive. In 2022, inflation surged dramatically, leading to a sharp increase in interest rates. Additionally, the war in Ukraine began in the spring of 22. Well, finally stock prices fell, but the level of uncertainty increased as well. With the macro world in complete chaos, not many expected much from stocks in 2023, as there were multiple economic unknowns. However, with the rise in interest rates, inflation rapidly declined. The excitement brought by artificial intelligence also boosted stocks, especially in the United States and technology companies. Even the disturbances in the Middle East didn't affect the positive momentum. The Sifter Fund performed exceptionally well in 23, generating an impressive 31% return. So, while investing in stocks has been frightening from a macro perspective in recent years, it's been highly profitable. Let's take a closer look at which companies performed best and worst in Sifter portfolio during the year 23. The top contributors were Disco Corporation, BE Semiconductor and Lam Research. And the detractors were Johnson&Johnson, ADP and VeriSign. It's worth noting that among the top performers was not, for example, the Danish pharmaceutical company Novo Nordisk, which was the best performer in 22. However, Novo's significance for the Sifter portfolio remained substantial this year, as it is our largest investment with approximately 8% weight. Based on stock returns, the biggest gainers were relatively unknown quality companies from Japan, the Netherlands and the United States. Let's investigate deeper into some of Sifter's top performers and underperformers with our portfolio managers. So let's get deeper into Disco Corporation, which was the best performer last year. Welcome, Olli.
Thank you.
Could you please share your thoughts regarding Disco? What's the company do and why did it fare so well?
Yeah, well, let's start from the basics. So, it's a Japanese company and it operates in the semiconductor industry. So they essentially sell these equipment which are used to cut and grind silicon wafers. And on the surface of the silicon wafers, their customers manufacture these various kinds of semiconductors like processors and memory chips. And then Disco's equipment are used to kind of cut those wafers into pieces and grind them into an even thinner form. And it's pretty much a niche market, but Disco largely dominates that with about 60 to 80% market share. So very much a strong niche player. What characterizes Disco is that for a long time their top line has grown more or less reflecting the global growth in silicon wafer production volumes. So no big surprises there. But over the past year, there are these two major trends which have emerged, which could suggest that, or are suggesting that Disco could grow much faster in the future. Mm-hmm. So those two trends are generative AI and then changing architecture in electric vehicles. Mm-hmm. And those are basically why that's important for Disco is that they are changing the way that semiconductors are manufactured into a direction where Disco's expertise is more important. And that has to do with something called a chiplet structure for semiconductors, and then compound semiconductors, so particularly the use of silicon carbide, so a mix of materials. And if we first consider the impact of AI, the thing is, with generative AI, you tend to need a lot of this high bandwidth memory in order to train the AI. So essentially, that consists of several DRAM chips which are stacked on top of each other, and then that is connected to the GPU, so graphics processing unit. And that structure, overall, the type of structure is called chiplet structure. And that's something that means that there's a lot of processes where Disco's equipment need to be involved in. And one that is particularly necessary, something where a lot of careful processing needs to be done, is when you stack those memory chips on top of each other. Very careful grinding is necessary to make sure that the structure actually works. Those kind of equipment that you need for it, Disco can charge very high prices for those. According to some sources, maybe 6 times more than the usual. So very specialized equipment. Now, what comes to the electric vehicles, well, we have seen electric vehicles selling quite well for some time. So that's not really a new development, and Disco has actually benefited from that for some time already, because some of the semiconductors that Disco's equipment are used to make are power semiconductors. So that's a specific type of semiconductor, that the type that converts and switches electric current. So in contrast to those processors and memory chips, which make calculations and store data. But the big thing over the past year is that it has become increasingly clear that these power semiconductors will be built on silicon carbide instead of just silicon wafers. So and why that is a big thing for Disco is that silicon carbide is very hard material, very difficult to process. So you need a lot more consumables to cut and grind those wafers. According to some sources, the consumable consumption could be as high as 10 times more. So that's what's really positive regarding electric vehicles for Disco.
So lots of expectations, at least, for Disco's business. How about risks?
Well, the share price to some degree has really run ahead of itself. So it's true that semiconductor stocks have appreciated quite broadly in 2023, but Disco's surge is really in a bit of a league of its own, and it looks like a lot of these positive developments regarding the ways that semiconductors will be made is already priced in now. So if there is any major disappointments in the adoption of generative AI or these modern type of EVs that rely more on silicon carbide, well, that could lead to a fairly significant correction in the share price. And also, it's true that while there are these positive developments in the horizon, really we haven't seen that much impact on Disco's earnings yet. So really estimating the exact magnitude of these positive developments is still a challenge.
Right.
And there's also some concerns regarding that. If this is really going to be such a big boost to Disco's business, are they able to really deliver that much of equipment to really serve this demand from originating from generative AI and these modern type of EVs? I mean, they are already operating at near full capacity. They say that they can serve the expected demand, but still, I mean,
manufacturing capacity expansion, perhaps.
Yeah, that could be a challenge.
Well, let's follow the company and the business it's very carefully in the coming months, and maybe we can decide then something that we want to take action. So our second biggest gainer last year was BE Semiconductor. So could you share your thoughts about BESI and what does it do and why the company has performed that well last year?
Sure. So BE Semiconductor Industries, or BESI for short, is a semiconductor equipment maker, or more specifically, it makes die bonders. So to summarize it, when TSMC or Intel has completed a wafer, and on this wafer, silicon wafer, you have individual dies, well, they're not exactly ready yet to be put into a motherboard. There's some back-end process steps to be had, and Besi then delivers machines for this, and specifically for the die bonding process then, of course. And in this die bonding process, what Besi's machines does is that it picks up a single individual die and places it then on a substrate. And the idea here, or what the industry really wants, is to increase the contact density between the die and the substrate. The reason for this is that it is a way to increase the energy efficiency of these chips and also lower the latency. And so Besi then has about 70% market share of this advanced die bonder segment, you can call it.
And that's the core business, right?
That's the core business.
And then there's the kind of growth business also booming.
Exactly, yeah. So, well, it so happens that Besi is furthest along in their, let's call it the next generation of die bonding technology called hybrid bonding. And this is what we also like to refer as their second growth driver or engine too.
Yeah. Okay. And how do you see the outlook for this hybrid bonding, and is it materializing now?
Yeah. There is a lot of excitement around hybrid bonding. For instance, a lot of the chip manufacturers are naturally very excited about what utilizing hybrid bonding can do for their chip performances. But it's also really important to remember that a great technology will not materialize unless it is economically sensible for all stakeholders involved. And to this end, Besi has done, and really a lot of what the excitement was around last year was that Besi was able to show quarter after quarter that they improved the throughput and the yield of their hybrid bonding machines, which they've also started to ship. Actually, that was already in 2021. And this really gives us confidence to believe that the adoption curve will materialize. And further along, some added excitement happened last year when we saw some news that high bandwidth memory 4, the next generation of high bandwidth memory, will likely utilize hybrid bonding in the process step where they vertically stack the memory chip on top of the GPU chip, and this necessitates hybrid bonding and therefore likely be semiconductors hybrid bonding die bonders.
Okay. So put it in short, it's a quality business, very focused in the semiconductor equipment manufacturing process.
Yeah.
It has a very good core business with 70% market share and nice growth business.
Yeah.
And this outlook is something that what has boosted the stock price.
Exactly. Yeah. It is the outlook that has boosted the stock price, but again, we saw a lot of evidence that kind of gives us further confidence that this adoption will happen, and it has already started, but we'll see more in the future.
It seems that you are quite excited about this business.
I definitely am, yeah. It's a lovely company to follow.
Okay, and we'll continue following. Well, BE Semiconductor was the second biggest gainer last year, but then Johnson&Johnson was one of the detractors.
Yeah.
And you've been following Johnson for many years now. And what's problem with Johnson? It's a beautiful pharmaceutical giant from US, but this year it didn't perform that well at all. But in 2022, it was one of the best performers.
Yeah.
So why so?
Well, one of the reasons Johnson was a detractor this year is because of the split off. It split off the consumer health business, right? And of course, as Johnson&Johnson investors, we got the shares and the return from that. But that is not, of course, counted in Johnson's ticker. So it gives a little bit harsher image than what it actually is. But on top of that, honestly, there's not that much of exciting things happening in Johnson&Johnson. So it is a very diverse healthcare company. It is the largest healthcare company, at least in terms of revenue. And this scale and stability and diverse nature is a strength in bad times, as we saw last year. But perhaps when investors are then looking for growth in companies, then, well, it could even be a drawback. As for the future of Johnson & Johnson, I don't really see anything really changing the earnings potential landscape. There are some patents that will go expire, but then there are other drugs that will fill those places. The only thing I'm really hoping for Johnson & Johnson is that their tort litigation issues will be resolved next year. But kind of betting on the swiftness of the US justice system is I would say, a losing bet.
But one could say that it's still a quality business. It's one of the best pharmaceutical companies, I would say.
Yeah.
Even though it's boring, as you mentioned, it's not growing that much.
Yes.
But on the other hand, it's defensive.
Yes. Yeah, it's definitely, don't get me wrong, it's a quality company, it's stable, there's some growth, right? And yeah, it's defensive, so it's in no way a bad business. But yeah, its defensiveness might have not been so attractive this year.
Okay. But we will still stay as owners for that company. Yeah. So our final case today is Disney Company, and we have owned Disney for roughly 2 years now. The stock price has been quite flat this year, but we are still owning the Disney. Alexander, you are following the company, so why do we own it?
We own it because, well, there's challenges ahead, but we still believe that there's more positive news to come than negative news. You can paint a few scenarios going forward. Some are bullish, some are bearish, but in our view, we are kind of leaning towards a more positive future. So a bit of background before we dive into the bull and bear cases. So Disney is a very large company, as we know. $90 billion of revenue was the last fiscal year. So it's quite a big company.
It's a huge.
It has 3 major segments that it reports. So we got entertainment, which is basically the media segment. And we got sports, which is basically ESPN sports. And then experiences, which is mostly consisting of Disneyland and Disney World and every other Disney theme park. So those are the 3 segments. And half is media, so entertainment, and the other half is basically ESPN and Disney, the Disney things, Disneylands combined. And the latter is doing quite fine. So Disneyland is doing great. There's no clouds on the horizon or anything like that. But the trouble child has been the media segment.
Is it only the streaming or the cable or both?
Well, yeah, as you mentioned, this media segment contains many different parts. And one of them is the cable TV and broadcasting business models, which are not doing so well in this modern world, as people are no longer willing to subscribe to a cable TV service. The hope is, of course, that these consumers that leave the cable TV world would then go into a streaming world, and of course they are doing that. But the hope is they would go to the Disney's own streaming service, which is Disney Plus, launched in 2019. And so far, that has happened. I mean, the growth of Disney Plus has been really good.
No, well, what are the positive scenarios? What bull cases?
The bull case is that Disney Plus would make a profit because in the last 5 years they have been operating in the red. And the good thing is that last year the old CEO was forced out and the even older CEO came back. So Bob Iger is now in charge of Disney and he has a plan to make the streaming segments profitable. This plan includes raising revenue, of course, more subscribers, and also by raising the average price for consumers by a significant deal. And on the cost side, of course, he's going to cut down on spending on marketing and also to a little bit cut down the spending on new content. Okay. If we believe, or let's say that he succeeds in this, then the model shows us that in 1 year's time, this Disney Plus streaming segment will be finally profitable.
How do you see the progress now? Is it going into the right direction?
So we have been following quite closely this year, or the for the last year. Three major criteria, because we already saw that Disney was in trouble maybe 1 year ago. So we follow the growth of the number of core subscribers, so North America, Europe subscribers for every quarter, and those went up. The average revenue per user also went up in every quarter, and also the streaming losses were moving in the right direction. So there is definitely, the momentum is heading in the right direction now. It was a different story 1 year ago.
And that's the reason for our, let's say, positive feeling regards.
Yeah, and also just one key point is that the company will raise the prices on its streaming services. And there is support from the industry, as every other streaming service like Netflix or Amazon Prime has also started to do these price increases. So they're kind of rising all the boats at the same time. So there's support from the industry to do these price increases.
Well, how about the bear cases or scenarios?
So the one bear case is that what is the price elasticity of consumers with streaming services? So when you raise the price, how many of those consumers will then leave the service altogether? And the worst case scenario is that the number of subscribers will no longer grow and start to decline.
Okay.
Another kind of bear scenario that we can paint is that our initial investment hypothesis with Disney was wrong. So we made the assumption when we invested in May 22 that the first phase of the streaming wars would be very bloody. Competitors would be trying to attract customers by deliberately underpricing their service to get critical scale, basically, because this is a very scalable business. Our assumption was that this would happen for the next 3 to 5 years, but after that, we will get into a more mature phase within the streaming industry, where there will be more focus on cash flows and margins. And the bear scenario here is that this would not happen either within the next 5 years. So that this bloody competition with prices and making losses would continue for a longer term.
Okay, interesting. And if we convince ourselves that the positive direction is, or it's going to the positive direction, then we might increase our position, which is quite small currently.
It's not a high conviction bet, no. But we are more positive than negative. That's our attitude towards the Disney as an investment as of right now.
Okay, that's about Disney. Then let's talk global stock diversification. As we have noticed last year, global allocation was a crucial part of any potential returns for stock portfolios. Of course, the Sifter Fund is globally diversified stock portfolio. So maybe, Alexander, you could explain our allocation principles in a short. Those are a bit differ to many funds.
Well, the allocation principle is quite easy. We don't have a direct allocation philosophy. Our way of working is that the good companies come to us. We have our own stock shifter philosophy, which gives us essentially a deal flow of potentially interesting companies. And if you find something from within this deal flow that is interesting enough that we decide to invest, then we invest regardless of wherever it comes from in the world, or regardless of whatever industry it is coming from. So you can say that the sector allocation is to some degree random. It is simply the output of this process.
Right. So we don't have any predefined goals how much we want to be invested in a certain sector or country.
No, we don't do that. We don't choose a sector like this is going to be the winner next year and then start picking from within that. No.
Right.
It's essentially just the output.
How was the sector allocation last year and how did it change?
We have roughly 40% of our investment in technology stocks. This includes software companies and also semiconductor stocks. This is up roughly 6 percentage points from last year. The main reason for this is that we invested into BE Semiconductor, which is a semiconductor company belonging to this category. On the other hand, the entire sector, the technology sector, including software companies and semiconductor companies, had a really good year. So they outperformed versus every other sector.
So valuations went up, and therefore the end game was that we are a little bit more in the IT technology sector currently.
Indeed.
Yeah.
And this was offset by lower weights in the pharmaceutical sector or healthcare sector, Johnson&Johnson is one key here. So when they made a split off and we got the Kenvue shares, we disposed of those entirely.
If you compare the Sifter current sector allocation to any, let's say, MSCI ETF or any global ETF, so what's the difference?
The main difference is that our allocation to technology stocks and industrial stocks is overweight compared to the global equity index. One reason for this is that these are sectors where it is easier for us to find suitable companies that have strong competitive advantages and that actually has a growth outlook in the future, and sometimes even attractive valuation as well.
Okay.
So that's why we are overweight in these two sectors, while we are also severely underweight in the financials because we don't do banks or insurance companies, as well as the energy sector because we don't invest into companies that are heavily dependent upon commodity prices like oil and energy stocks.
Right. Okay, that's about the sector allocation. How about the country allocation? What's the current allocation in between the countries?
So a little bit less than half is invested into North America, and this is roughly 15 percentage points less than the world equity index. So we have a lower exposure to North America than that index. Instead, we have an overexposure to Europe and a somewhat corresponding exposure in Asian stocks.
Yeah. But as once again, it's the output of our process,
Indeed.
not the goal. No, we don't invest in China,
No,
for example. No, we don't invest in African countries
no,
or South America even.
no.
Yeah.
So yeah, we're mostly Europe and North America right now. Funny fact as well is that last year we had 5 Japanese companies in our portfolio and our sector weight to Asia was 15%. This year we have only 3 companies from Japan and 1 from Taiwan. And so 2 less. And our sector exposure is still the same. So Santeri, why is this? Do you have an idea?
I think it's our top performer this year.
Yeah, indeed. So Disco Corporation has been outperforming to such a degree that it has essentially made up for the selling of 2 other lines in the portfolio.
Yeah, that's an interesting fact. Let's talk about the risks a bit more. And after a good year like 2023, we had a over 30% return for Sifter Fund. So have we taken too much risk in the previous years? How do you see and how would you evaluate the risk regarding the Sifter Fund and the investments?
Well, one way to estimate the risk is just to look at the volatility of the fund. And just looking at that, it doesn't look like Sifter has taken any unusual risks. It looks more like Sifter has earned a high return for a fairly unusual level of risk. And usually we don't look at these price trends, but for the purpose of answering this question, we can look at some metrics that are pretty popular in the fund management industry in estimating fund risks. So this chart is based on Bloomberg terminal data and calculations, and you can see Sifter's. You can see the volatility there represented in the first column, and you can see that Sifter's volatility over the past 5 years has been a bit higher than for the iShares MSCI All Country World ETF. Which tracks the global equity markets fairly broadly.
But isn't that quite natural when you have quite concentrated 30 stocks portfolio instead of 3,000 companies index?
Sifter's volatility isn't as high as you might think based on what you just said, and I think most investors would be at least equally interested in how much return they can get for a given level of risk. And Sharpe's ratio, the second column there, shows you that. So it represents the excess return of each fund relative to the risk-free rate over that period, and then divides that with that fund's volatility. So there we can see that Sifter's Sharpe's ratio is significantly higher than for the broad stock market ETF there, suggesting that Sifter has offered a better risk-adjusted return. Then, well, there are other numeric metrics also which we can use to answer these questions, and they also suggest that Sifter hasn't taken unusual risks. You can do this linear regression analysis here using this same iShares ETF as the benchmark, even though it's not an official benchmark for Sifter, but we think that it represents the global equity market fairly well. Well, just looking at the kind of slope of that linear regression, the beta there, well, the result for Sifter is about 1. So Sifter's volatility hasn't materially diverged from what the global equity market has seen. So if the market has been going up, Sifter has typically gone up more or less at the same extent, and down vice versa. But if we look at the alpha, which is then the coefficient of that linear regression, well, that kind of indicates how much excess return Sifter has provided over that benchmark when you clean out all that market-linked volatility there. And, well, that number is 3.8, so it just suggests about 3.8% of annual excess return. And
That's over 5 years.
Over 5 years, so annually, on average, about that much.
Yes.
And then we also have the R squared there, which kind of tells you how much of Sifter Fund's volatility or the variance is explained by this model. And obviously, there is a lot of variance that this model doesn't explain. So that's why it's always good to use several metrics. And finally, we have the information ratio there, which kind of answers the question that, or kind of tries to give you a feel of how much excess return and then how consistent is that excess return. So essentially, it's just that the excess return divided by the volatility of that excess return, and we have the result that you see there. Obviously, this number is more useful when you compare it to some another alternative. But each investor have their own short list of alternatives, and we haven't tried to guess which those are. So, but you can use this number as you wish. But in addition to these kind of price volatility metrics, I mean, I obviously we could consider risk from other perspectives like concentration, which you already touched on. So, the more concentration there is in a portfolio, typically that leads to higher volatility. And obviously there's much more concentration in Sifter Fund than in the global equity market overall. So about our 10 largest lines represent more than 50% of our assets, while for the global equity index, it's less than 20% for that metric. But I mean, if we don't have any concentration anywhere, we wouldn't have any chance of beating the market. Right. So, I mean, it's pretty natural to have concentration somewhere. And the fact that we can also then concentrate our research efforts to these handful of cases, I mean, that should mitigate the risk also to some extent.
But finally, the business risk. Maybe that's the one what we are mostly following.
That's right. Yeah, I mean, we try to find these quality companies, and that in itself, we think should mitigate some of the risks as well. So just thinking of one example, the fact that we like companies with low leverage should limit the credit risk of our portfolio.
Do we see any potential for stocks in the coming years, and how do we evaluate and measure the potential? Maybe you could say a few words about the earnings yield, what we are applying.
Yeah, based on our earnings yield forecast, there still seems to be good potential left. So just as a reminder for the audience, so we use the 5-year earnings yield as kind of a way to estimate whether our holdings are fairly priced. And so essentially we have the forecast for each of our portfolio companies extending 5 years into the futures. And then we use that 5th year earnings per share and compare that to the current share price in order to get this estimate for the earnings yield. And currently the median earnings yield is about 5.6% for the portfolio, so still a fairly healthy number. And just to give you some context, in fall 2022, if you compare that 5.6% to that fall 2022 level, I mean, the yield has come down by a tenth or by a sixth, which, it's somewhat down, but considering how much the fund has appreciated, it maybe hasn't come down as much as one might think. And, well, one reason is that on average, on a typical year, the portfolio companies grow their earnings. And back then, we looked at the 2027 earnings forecasts. Now we are already looking further into 2028. So that also partly explains why there is still potential left by quite a healthy bit. And the other reason is that, we have hiked our estimates here and there. And that's basically because we have these fairly conservative forecasts to begin with. And as we see that the companies meet our expectations or even exceed them, that is a reason to maybe have a slightly more optimistic view on the future. So it's kind of a cumulative learning process, knowing the companies better and trusting them more.
Maybe it's good to remind that we don't promise any stock price returns, of course, but we are more positive towards business returns of our companies for the next 5 years.
Yes, we are still positive about them. Obviously, how the market values those earnings is not in our hands, but these are our best estimates regarding how the earnings will develop.
Yeah, thank you, Olli. Let's discuss lessons learned. So we always talk about cumulative learning curve. And that's one thing when we analyze companies, we want to see if there's a cumulative learning in that company, for example, in certain technology or R&D or something like that. But also when it comes to our own investment process, we like to see is there's a cumulative learning in our own way of thinking. And two things what we I identified last year was that we want to see and find companies with a very good competitive advantages and also the potential underlying growth in the sector. Those were the two factors what we identified when we reflected our own way of analyzing the companies. So what's your thoughts and take on that?
Well, when it comes to competitive advantages, first and foremost, for us to be able to actually invest in a company, we have to identify a clear competitive advantage and also preferably a clear investment hypothesis. So we know when we are going in the right direction or in the wrong direction with a company. And we also, the reason why it was maybe highlighted a little bit last year more was that we had this kind of project where we analyzed our previously rejected investment candidates and the reason behind why we rejected them. And one of the kind of key lessons that we learned from this project was that in those cases where we were not able to identify a clear competitive advantage, either because we didn't understand what it was or it was not present at all, first of all, we rejected that as investment candidate, but if we still would have invested, hypothetically, our returns would have been poorer.
So stock price was down, basically, during the last 3 years. That was the time period.
Yeah, on those companies, yes.
Yeah.
And when it comes to end market growth, we have seen previously that there are a lot of companies also previously in our portfolio and in the investable universe that could be classified as quality companies in the sense that they have a strong financial position, they have a good management, they even have clear competitive advantages. But the problem with these, what you might call value traps, is that for one reason or other, their earnings are not growing, and usually the case is that their end market is not growing. And so we have seen that when we try to pay a fair price for a really good company, that we have succeeded better in doing this rather than trying to find kind of gold coins through in the bargaining bin.
So one could say that lesson learned was that try to avoid those value traps,
Yeah,
which looks quite cheap
yeah,
in valuation.
Yeah.
And on the other hand, you also we don't want to pay too much, for example, for to like a popular businesses,
exactly.
because those are only based on the expectations very
Right,
often.
right.
So we try to find the quality businesses with nice end market growth also.
That's right. And it's a good point that it doesn't mean that we only or we try to invest in these highly valued growth companies. Of course, there are good investments in this category as well. But the point is to try to kind of find a fair valuation. And what has been actually quite helpful for us to get a sense of what is a fair valuation is then the 5th-year earnings yield of our portfolio. Because in a nutshell, when we have a decently broad enough diversified portfolio and we have our own estimates of those earnings yields of the companies, we get a quite good sense, I would say, of what is a reasonable earnings yield to expect from quality companies across our investable industries.
All right, this concludes the summary for the year 23. Hopefully you gained new insight from this. Finally, it's good to remind that any companies we presented are not investment advice or recommendations. The purpose of the videos is solely to transparently explain how the Sifter Fund operates. Thank you for being with us and please subscribe to Sifter on YouTube. Wishing you a very good year.